Hey everyone, welcome back to Trek for Wealth, the podcast where we talk about money the way real people actually talk about money. I'm Avery.
And I'm Grant. And Avery, I have to say, this week the news has been impossible to ignore.
It really has, because if you drove past a gas station this week and did a double take at the price sign, you are not imagining things.
Oil just did something it has never done in over 40 years of futures trading. And the reason why goes straight back to the Middle East.
So here's the headline. Last weekend, the United States and Israel launched coordinated strikes on Iran. The market was closed Saturday when it happened, and when oil trading opened Sunday night, it was immediately chaos.
U.S. crude oil surged more than 7% in a single session. Brent crude, the international benchmark, spiked 9%, briefly touching $82 a barrel. And by Friday of this week, oil had crossed $90 a barrel, up 36% in just 7 days.
36% in 1 week. That is the largest single-week gain in oil futures history going back to 1983.
History, not just recently, ever.
And the reason markets are reacting this strongly comes down to one very narrow piece of water. Grant, tell our listeners about the Strait of Hormuz.
So picture a bottleneck, literally a narrow strait of water between Iran and the Arabian Peninsula. Every single day, about 20 million barrels of oil flow through that channel. That's roughly 20% of the entire world's daily oil supply. Saudi Arabia, Kuwait, Iraq, Qatar, the UAE, all of their exports pass through that strait to reach the rest of the world.
And right now, that strait is effectively closed.
Tanker traffic has come to a near halt. Ships are piling up on both sides, unable to get insurance for the voyage, wary of drone and missile attacks. 4 vessels have already been hit since the conflict began. An analyst at Rystad Energy called it an effective halt of traffic through the world's most critical oil choke point.
Which means roughly 9 million barrels of oil per day are currently off the market, either because facilities have been hit directly or producers are taking precautionary measures.
And the market is now pricing in a worst-case scenario where oil could hit $100 a barrel or even higher if this drags on.
Now, here's where it gets personal for every single one of our listeners, because this isn't just an abstract market story. This is a gas pump story, a grocery bill story, a Federal Reserve story.
Let's take them one by one. Gas prices first because that's what people feel immediately. Before this conflict started, gas was averaging about $3 a gallon nationally. Analysts are now projecting that could rise by 10 to 30 cents on average in the next few days, with some stations seeing prices jump as much as 85 cents.
And that number can keep climbing. If the strait stays disrupted and oil hits $100 a barrel, analysts warn that national gas averages could reach $3.50 by summer.
Now, some people hear that and say, wait, America produces its own oil now. We're a net exporter. Why does this affect us?
And this is one of the biggest misconceptions in personal finance. Grant, break that down.
Oil is a globally priced commodity. It doesn't matter where it's pumped from. When the global price of oil goes up, American gas prices go up. Full stop. We are not an island. If 20% of the world's oil supply is suddenly unavailable, that affects the price of every barrel everywhere, including the ones we pump in Texas and North Dakota.
So we all pay the price, and it doesn't stop at the gas pump. Think about everything that requires transportation, which is essentially everything you buy. Every box on a store shelf arrived on a truck that runs on diesel. Higher oil prices are a stealth tax on the entire economy.
And here's the kicker for anyone watching interest rates. Before this conflict started, markets were pricing in a high probability of a Fed rate cut in late March. Those odds have now essentially collapsed to near zero because oil price spikes mean inflation. And inflation means the Fed keeps rates higher for longer, which means mortgages stay expensive, car loans stay expensive, credit card rates stay high.
So this conflict, thousands of miles away, just delayed potential rate relief for millions of American households.
That's the interconnected world we invest in.
Okay, Grant, this is your moment, because this is exactly where financial history becomes the most valuable tool in the room. We have seen this before.
We absolutely have, and I want to take our listeners back to October 1973. because what's happening right now rhymes so closely with that moment that it's almost eerie.
Set the scene.
It's October 1973. The Yom Kippur War has just broken out. Egypt and Syria have attacked Israel. The United States supports Israel and begins resupplying them. And Arab members of OPEC respond with a devastating economic weapon, an oil embargo against the United States and any nation that supported Israel.
And the price of oil explodes.
The price of oil per barrel first doubled, then quadrupled, from about $3 a barrel to nearly $12 in less than a year. In today's inflation-adjusted terms, that's roughly equivalent to going from $17 to $61 a barrel overnight.
And what happened to the stock market?
The S&P 500 lost 17% of its value in under 2 months, and over the following 11 and a half months, it plummeted 44% total. It was the steepest economic contraction since the Great Depression. The Federal Reserve at the time described it as coming at the most inopportune time. Inflation was already running above 10%, industrial capacity was maxed out, and then oil prices quadrupled on top of it all.
Life literally got slower, darker, and colder for ordinary Americans. Gas was rationed, speed limits were imposed, the lights were turned off at Times Square to save energy.
And then came the 1979 crisis, triggered by the Iranian Revolution this time. Oil prices nearly doubled again. Unemployment across Western economies reached levels not seen since the Great Depression. France, the US, the UK all hit 15% or above. Japan went from 1% unemployment to 13.5%.
These weren't just bad markets. These were wealth-destroying, life-changing economic events.
And they were triggered, both times, by conflict in the Middle East disrupting the flow of oil.
So Grant, here's the question everyone listening is asking right now. Is this 1973 all over again? Should I be panicking?
That is the right question, and history gives us a nuanced answer. Let me share both sides honestly.
Let's hear it.
The case for concern: the oil shock is real, the strait is disrupted, inflation was already above the Fed's target before this started, and the conflict shows no sign of quick resolution. President Trump has said it could last weeks, possibly much longer. That combination is genuinely worrying.
And the case for calm.
A few things are different now compared to 1973. The United States is a net oil exporter today. We have far more energy independence than we did 50 years ago. The Strategic Petroleum Reserve, which was actually created because of the 1973 crisis, exists precisely to cushion shocks like this one. And one energy trader at CIBC put it well this week. She said the crude market has been extremely measured so far. No panic. Professionals are treating this as a disruption, not yet a catastrophe.
And here's the historical stat that I think our listeners really need to hear. Over the last 9 decades, analysts have studied every major geopolitical event: wars, terrorist attacks, assassinations, financial crises. And the finding is clear. Emotion-driven sell-offs during geopolitical events are almost always short-lived. And investors who panic and sell almost always regret it.
History implies that if a crash event does occur, it would be a buying opportunity for patient, long-term investors. That has been true after every single major conflict since World War II.
Every single one.
The investors who made money in the 1970s oil crisis weren't the ones who sold everything when the embargo hit. They were the ones who repositioned thoughtfully and waited. So let's get practical. What do you actually do right now? 3 moves.
Move 1. Don't make panic decisions. The single most expensive thing most investors do in a crisis is sell at the bottom out of fear. If your financial plan was sound before last weekend, it didn't suddenly become unsound because of what happened in the Persian Gulf. Volatility is uncomfortable. It is not the same as danger.
Move 2. Look at your energy exposure. Oil companies like Exxon and Chevron actually rise when oil prices spike. Their profits go up. Defense stocks like Northrop Grumman and Lockheed Martin are also historically strong in conflict periods. This doesn't mean chase hot stocks, but if you have zero energy or defense exposure in your portfolio, this is a moment to think about whether that balance makes sense.
Move 3. Watch the Strait of Hormuz, not the headlines. The single variable that will determine whether this is a brief disruption or a prolonged economic event is whether the strait reopens. Every week it stays closed, the pressure on global oil supplies compounds. Every sign of negotiation or de-escalation is a positive signal for markets. Tune out the noise and track that one data point.
And move 3.5. If you have an adjustable rate mortgage, a car loan coming up for renewal, or any significant floating rate debt, this is a reminder that rates staying high longer is now the base case. Lock in fixed rates where you can.
That's the move most people miss. The conflict isn't just an energy story, it's an interest rate story too. Grant, close us out. One sentence of historical wisdom for our listeners this week.
Every generation faces a moment when the world feels like it's coming apart. And in those moments, the investors who keep their heads and remember that markets have survived every single crisis in history are the ones who come out ahead.
50 years ago, the lights went out in Times Square. The stock market fell 44%. Gas was rationed, and the American economy and American investors came back stronger.
History doesn't guarantee anything, but it's the best guide we have.
That's Trek for Wealth. Thank you so much for listening. If this episode helped you make sense of a genuinely scary week in the markets, share it with someone who needs to hear it.
We'll link to some of our source material in the show notes so you can dig deeper if you want. Stay informed, stay calm, and stay on the trail.
We'll see you next week. Keep trekking.
Take care, everyone.